Investing and trading have a bad reputation. If this is your first time doing it, investing may seem like something only the wealthy can afford. However, investing is easier than ever before when you distinguish truth from fiction. Try looking past common misconceptions. You never know if it could be perfect for you. Hello, and welcome back to our channel. Today we will talk about investing myths holding you back financially. So prepare to take note and let go of certain habits to invest and earn. Let's get started. Myth number 1. Investing is only for the wealthy. Investing only for the wealthy is a common misconception that prevents many people from investing. The idea that only the wealthy can invest is based on the assumption that investing requires significant capital. However, this is not true. In reality, there are many investment options available that require only a small initial investment. For example, many mutual and exchange-traded funds, ETFs, allow investors to start with as little as $100. Additionally, some online brokers offer commission-free trades and low account minimums, making it easier for anyone to invest. It's also worth noting that investing is a crucial component of building wealth over the long term. By investing early and consistently, even with small amounts, you can benefit from the power of compounding returns. This means that your money will earn interest, and then that interest will earn interest, leading to exponential growth over time. Overall, the belief that investing is only for the wealthy is a myth that holds many people back from building wealth over time. Myth number 2. You need a lot of money to start investing. You need a lot of money to start investing is another common misconception that prevents many people from investing. While it is true that some investment options require a large initial investment, there are many other options available that require very little upfront capital. Mutual funds are among the most popular investment options that require a low minimum investment. A mutual fund is an investment vehicle that pools money from multiple investors to purchase a portfolio of stocks, bonds, or other assets. Many mutual funds allow investors to start with as little as $100, making it accessible to nearly everyone. In addition, some online brokers offer commission-free trades and low account minimums, making it easier for anyone to invest. Furthermore, some investment apps allow investors to start with as little as $5, making investing accessible to more people. Myth number 3. Investing is too risky. On number 3, we have risky situations. Investing is too risky is a common misconception that often holds people back from investing. While investing does involve some level of risk, it's important to understand that not all investments are created equal, and the level of risk can vary greatly depending on the investment option. Some investment options, such as individual stocks or high-risk mutual funds, carry a higher risk level. However, many other investment options, such as bonds, index funds, and real estate investment trusts, or REITs, are considered relatively low risk. By investing in a range of different asset classes, such as stocks, bonds, and real estate, investors can reduce their exposure to any particular investment and spread their risk across various investments. It's also important to understand that investing is a long-term strategy. While there may be short-term fluctuations in the market, historically, the stock market has generally produced positive returns over the long term. By staying invested long-term and investing in various asset classes, investors can reduce their risk exposure and potentially benefit from positive returns over time. Myth number 4. You need to be an expert to invest. You need to be an expert to invest is a common misconception that can prevent people from starting to invest. While it's true that some investment strategies require a high level of expertise, it's not necessary to be an expert to start investing. In fact, many investment options are designed for beginners and do not require any specialized knowledge or expertise. For example, mutual funds and exchange-traded funds, ETFs, are popular investment options designed for retail investors and do not require specialized knowledge to invest. Additionally, Many online brokers offer educational resources, such as articles, tutorials, and webinars to help investors learn more about investing and make informed investment decisions. Keep in mind that investing is not an all-or-nothing proposition. Many investors start with small investments and gradually increase their investment over time as they become more comfortable and confident. This allows investors to gain experience and knowledge while minimizing their risk. Investing is about making informed decisions based on research and analysis. But it's also about accepting some level of risk and being prepared for possible losses. Thus, it is just a myth that you need to be an expert to invest, which can prevent people from starting to invest. With time and experience, you can gain confidence and knowledge and build a successful investment portfolio. If you're enjoying this video, hit the thumbs up button, and if you want to know more about investing strategies, subscribe to the channel for more. Now, let's debunk more myths. Myth number 5. You can't beat the market. You can't beat the market is a common belief among investors that can lead to a passive investment strategy. While it's true that beating the market consistently over the long term is difficult, it's not impossible. There are many examples of successful investors, such as Warren Buffett, who have consistently outperformed the market over decades. However, it's important to note that beating the market requires significant time, effort, and expertise. It requires careful analysis of individual companies, understanding market trends and economic conditions, and making informed investment decisions based on research and analysis. For most investors, attempting to beat the market is not a realistic or advisable strategy. Instead, a more prudent approach is to focus on building a diversified portfolio of low-cost index funds or exchange-traded funds that track the overall market's performance. This approach allows investors to benefit from the market's overall growth while minimizing risk through diversification. It's also worth noting that attempting to beat the market through active investing can result in higher costs, such as trading fees and taxes, which can eat into investment returns over time. In contrast, passive investing through index funds and ETFs tends to have lower costs, making it a more cost-effective investment strategy. Myth number 6. Investing is a get-rich-quick scheme. Investing is a get-rich-quick scheme is a common misconception that can lead to unrealistic expectations and poor investment decisions. The idea is that investors can quickly and easily make a lot of money by investing in the right stock or fund. While it's true that investing can lead to significant wealth accumulation over the long term, it's not a get-rich-quick scheme. Investing requires patience, discipline, and a long-term perspective. A more prudent approach to investing is to focus on building a diversified portfolio of low-cost index funds or exchange-traded funds that track the overall market's performance. This approach allows investors to benefit from the market's overall growth while minimizing risk through diversification. Investors should also have a long-term perspective and avoid trying to time the market or chase short-term gains. Instead, investors should focus on investing regularly over the long term and allowing their investments to grow through compounding. So, there you have it, folks. These are the top 6 investment myths that are holding you back financially. Don't let these myths prevent you from building wealth and achieving your financial goals. Thanks for watching, and we'll see you in the next video.